Joining me right now to weigh in is Neuberger Berman Group President and Chief Investment Officer, Joseph Amato. Joe, it's good to see you.
Good to see you,
Thank
Maria.
you so much for joining us. Your reaction to this global...
What a morning to be here,
yeah.
huh? I think this sell-off is really coming in a period of sort of strong global fundamentals. So that's what we think, is really the important driver of where markets are going to be in the future. So we see strong economic growth across the globe, whether it's developed markets or emerging markets, and that's leading to stronger earnings growth. We saw a strong fourth quarter performance where you had double-digit earnings growth, and credit markets still have a benign environment. So as we look at those fundamentals, we think this backdrop is more reflective of complacent pro-risk behavior, some of the things that you were just talking about.
What triggered this then? Is it the worry about 3% on the 10-year yield? Is it a worry about 2.9% growth in wages year over year that we saw in the jobs number? Why all this hysteria if everything's so great?
I think it's the expectation that rates may move higher quicker. If, in fact, the economic environment is growing at a higher clip and you see some signs of inflation, if the Fed is leading the rates much higher, then markets are going to react to that. And we have a long period where we haven't had a correction also. You have to keep that in mind.
Sure. The irony here is that if stock prices collapse the wrong way, if stock prices fall sharply, the dollar rises as it's been doing, the 10-year yield goes up, the Fed actually has less reason to raise interest rates more aggressively. So my question back to you is, what has actually changed that has the market so upset?
That's what I just asked.
Yeah, we don't think a lot has changed. I think certainly the environment of higher rates is reality because the Fed has probably been a little bit behind in terms of its and bond market's been a little bit behind in reacting to where the Fed is going to be. Well, so usually it's not one thing that leads to these things. It's a combination of things.
Is it rates? The fact that because you just said a minute ago that there's an expectation that the Fed is going to raise rates more.
And what I'm saying is the Fed doesn't have to do so much if all of these things are happening.
And I think that's what the market's going to take now some days to get their arms around, and these things don't necessarily. We're seeing that this morning, right? We had futures were up a little bit at one point, now they're down. So markets take some time to sort of digest what the fundamental picture is.
Help me in regards, because I think there's going to be a cap on rates because there still is this thrill for yield and everyone's still chasing it. If we go over to Germany, Japan, their yields are exceptionally low. They love coming over here. Seeing the 10-year at 2.7%, why aren't they coming in and buying it hand over fist, right? Won't that cap rates from going higher?
I think it will. And John and I were talking about that earlier before the show, which is that low-rate environment in Japan and Germany in particular, I think will keep demand for the long end of the Treasury curve reasonably strong. Keep in mind, rates are at whether it's 285 or 275. In the scheme of things, those rates are not high in the context of where the economic growth is really for the U.S. economy.
But this shows you that the stock market, though, then can't tolerate or won't tolerate yields that are significantly higher than this. Because, again, we've had a Fed that has pushed assets into anything that was risky since the 2008 financial crisis, and you have a Federal Reserve that's now trying to normalize itself. And it begs the question of whether investors really understand what an unwind of a $4 trillion balance sheet does to not only the bond market, but the stock market and real estate and junk bonds and emerging markets and cryptocurrencies.
Is that what this is? $4.5 trillion rolled in?
Well, I think the inflection point with central banks is an important issue. We've talked a lot about that in our pieces that we've written for clients, where you have an environment where balance sheets were expanding over the course of the last number of years, and now that's starting to move in the other direction, led by the Fed. So that's an issue.
Well, we've never seen this.
I mean, this gets to how confusing markets can be, because from my perspective, that's a really old story. I mean,
the wind down of $4.5 trillion?
The Fed winding down, it's easy money. I mean, they've been raising interest rates since December 2015. They told us in September of last year that they were going to be winding down their balance sheet, and they telegraphed telling us
that. But it's unprecedented.
For months before that. So the market is supposed to be forward-looking and price in all these things.
But saying it and doing it are two different things.
But the market is supposed to be forward-looking, and we've known this for years that the Fed was.
We've known it, but we haven't seen it. It's going to be $50 billion a month, right, for several years to get down the.
I think
with the expansion,
that's what the Fed said. $50 billion.
Of that balance sheet has created, undeniably, it's created some distortion. So when you go from central bank balance sheets from $4 trillion to 13, 14, 15 trillion, that created some distortion. So the unwind there is an element of unknown about that, as much as the Fed has telegraphed what its balance sheet roll-off is, and I think the market's been expecting that. But that goes back to the point I made earlier, where you've had some complacency, particularly in fixed income markets over the course of the last year.
I wonder, let me just ask this question. Jay Powell took over yesterday on the day that the market collapses.
Yeah, welcome to the Fed.
The 1987 crash 2 months after Alan Greenspan took over. And you've seen similar moves in the stock market, not of a 22% decline in one day, but when Fed chairmen take over the central bank here in the United States. So to what extent is that nervousness or uncertainty playing into market volatility? We don't know what Jay will do.
I don't think Jay coming on board is a driver, but that said, if you look back historically, markets always seem to test the new Fed chairperson. So that's something to keep an eye on. How the Fed reacts. The Fed has not said anything so far.
Now the million-dollar question, what do you do? What are you telling clients?
Well, I think this gives you an opportunity. If you think you missed the big move in markets, so 3 weeks ago we were sitting here and markets are up 7 or 8%, and people thought, oh my God, the markets are up 20-something% last year and upset. I missed it. When in fact you now have an opportunity because the fundamentals remain strong.
So you're buying the dip?
Yes.
Yeah, listen, I think we're tiptoeing around a couple things. I mean, the first thing we're tiptoeing around is that wages went up 2.9%. The market was not expecting that. Now, when wages go up 2.9%, our company's going to get the productivity that justifies those wage gains. So that's a capital cost that's higher now for them, right? It's labor. Then you've got rates going up. So what's happening is I just see this as the market's trying to digest risk. And so where would you put money now, given that we know that rates are going higher, labor is getting higher. Some companies' valuations are excessive, especially certain areas. Where's the best way I should channel my energy today?
So we would, from an asset allocation standpoint, certainly tilt toward the global equity asset class because we think the earnings outlook and the economic outlook is strong. Within the credit markets, we would lean more toward credit than duration risk because we do think that rates will probably grind higher over the course of the next 12 to 18 months.
So you're talking about Europe and Asia?
This sell-off in some perspective. We've been talking about 1987. We were talking about this off camera. The 1987 decline was 22% in one day. You know, we're talking about 4.6% yesterday, maybe another 2 points today. How big a deal is this in your career of looking at these market sell-offs? Is this a dime a dozen?
Market was up 40%.
That's a great point, Maria, because if you think about the last drawdown was maybe early 2016 when you had fears of U.S. recession and China weakening, oil prices were really low, markets traded off about 10%.
Yeah,
you had the markets then rally to mid-year, so you saw a 20% move up to Brexit. Markets then traded off a bit, and then since Brexit you had a 40% move with no corrections and low volatility. So this is a culmination of an environment that is quite unusual historically. So corrections that you've seen are normal in a market that's been
so
performing.
What's unusual
the way
isn't the sell-off we're getting now; it's how big the run-up was leading up to.
Well, and the low volatility that we experience. It's quite unusual to have that level of low volatility with markets moving up the way they do.
I mean, look at that chart over the last year of the NASDAQ.
The Dow had 10 1% moves in all of last year. I think it's had 3 in the last week. So volatility.
Well, this move in the Dow, I think, is in the top 100, barely.
Right.
It's not in the top 10.
Well, I think it's a good point that we were up better than 40%, and yesterday we were down 4%. So keep it into context. Joe, good to see you. Thank you so much. Joe Amato joining us there, Neuberger Berman.